When trading Bitcoin, you can guess based on market sentiment, or you can look directly at the math forcing the price to move. To see that math in action, we use a liquidation heat map. The vertical axis represents Bitcoin's price, and the horizontal axis tracks time. The colors on this map track leverage. Dark purple areas show where trading volume is light and safe. But when you see bright yellow horizontal bands, you are looking at a concentrated cluster of leveraged traders, forced by their brokers to liquidate if the price hits that level. In crypto markets, price action acts as a mechanical hunter, drawn like a magnet to these high-density nodes of forced liquidations. We are going to track exactly how this works by breaking down a 5-day sequence of market data from August 18th through August 22nd. By identifying where these bright yellow bands accumulate, we can map the structural probability of major market moves before they occur. This heat map shows the baseline on August 18th. Bitcoin's price consolidates around $64,500. As the price trades flat, a bilateral trap forms. Traders are opening leveraged positions in both directions, laying down lines of risk immediately above and below the current price. Directly below the price action, an intense yellow cluster is forming at $64,000. This is a massive accumulation of long leverage, traders who will be forcibly sold out if the price drops to that level. We see a mirror image above the price, a dense band of short sellers waiting to be liquidated if the price pushes past $65,500. The price is now boxed in by two distinct zones of high-density risk. This flat consolidation period is how the market builds fuel. Every new leveraged trade adds another layer of potential energy to those yellow bands. With leverage building densely on both sides, price action is structurally incentivized to seek out and trigger one of these two liquidity clusters. On the morning of August 20th, the price line surges upward, breaking towards $70,000 and instantly melting away the upper yellow band. When short sellers hit their liquidation price, their broker forces them to buy back the asset at market rate. This forced buying pushes the price higher, which immediately triggers the next short seller's liquidation price. This chain reaction causes price to accelerate rapidly into the $72,000 range, consuming entire layers of short positions in a matter of hours. The dense yellow resistance bands that sat above the price have been erased, leaving behind a sparse, dark purple vacuum on the heat map. The squeeze reaches its climax with one final sharp vertical price spike, hitting the $75,000 ceiling. This aggressive rally was driven by a mechanical cascade of forced buy orders, leaving the market structure heavily overextended. On August 21st, the upward momentum slows. As the price grinds towards $78,000, a new type of liquidity begins to form. Look directly below the climbing price line. Thick, bright yellow lines are building upward, trailing behind the current price as it nears $80,000. These bright bands between $74,000 and $76,000 represent late-entering momentum traders chasing the rally with high leverage. We see a stark contrast here. There is an incredibly dense floor of liquidity built up underneath, but an exhaustion of dense targets above the $78,000 level. The market is now severely skewed. The magnetic pull of forced orders is concentrated entirely to the downside. With no resistance targets left to squeeze above, and a massive pool of long liquidity trailing below, the market has developed a deep structural vulnerability. On August 22nd, the market turns. The initial red candle breaks below the $77,000 mark, beginning the hunt for those long liquidations. This triggers the flush. Forced selling from liquidated longs creates a downward cascade, pushing price into deeper pools of liquidity. The price slices straight through the thickest yellow bands near $76,000, triggering a massive wave of automated market rate selling. The heat map shows the result. Those dense yellow bands have been completely vaporized, leaving the space wiped clean. As price stabilizes, the leverage cycle resets, returning the market's structural balance to a state of equilibrium. The drop cleared the over-leveraged foundation, acting as a mechanical reset of the entire price structure. A price chart tells you what happened in the past, but a liquidation heat map maps the exact location of active risk in the present. In 5 days, we watched a complete mechanical cycle: accumulation, the upward squeeze, the formation of vulnerability, and the final downward flush. Comparing the wound-up bilateral trap on the left to the cleared state on the right shows how the market removes excess leverage. For professional analysts, predicting exact price ticks is secondary to locating the levels where other traders will be forced to execute market orders. When leverage reaches this density, these zones become primary gravitational centers for price action, defining the highest areas of risk. By reading the concentration of that leverage, you can identify structural vulnerabilities and anticipate market cascades long before they are triggered.